Dustin Tibbetts with Passport to Wall Street. We're talking about your trade of the week today, and we're going to do something a little bit unique. Maybe you haven't seen in a while. Here's the thing. We have had a lot of long positions. We talked about airline stocks, oil stocks. We've talked about even some retail stocks, Limited Brands being one of the most recent ones, toy companies. We've done a lot of long positions over the last few weeks, and if you take a look, a lot of them have done very well. But here's the thing. Now we're getting to this point where the stock market, it's a little bit shaky, right? And I'll use the analogy of a juggler that puts plates on a bunch of sticks, and he spins the plate and spins the plate, spins it. For the last few years, he's been able to just stand there and watch the plates spin. Very easy, no hard work. But now, some of those plates are starting to slow down and get wobbly, and I reference the individual sectors of the market. So you've got some sectors getting a little wobbly, some are still spinning fine, but some of them are getting wobbly and people are running around and they're checking out some different stuff. So it may be time to have a little bit of protection. Now, thankfully, protection is pretty cheap these days, but how do we want to go about it? Well, imagine if all you had was long positions in your account, then if the markets even fell a little bit, you're going to feel that pain. Does it make sense to have a little protection to play for a little bit of a drop? And so that's what we're going to take a look at today. We're going to look at the symbol SPY. Many of you guys know that that is the S&P 500. It's an exchange-traded fund that is based around the S&P 500 index. So what we want to do is we want to use this vehicle with a short position so that we can offset some of our long positions if the markets happen to fall a little bit. Maybe we can make a profit on this while the markets fall, and because maybe you like to have long positions and you'll wait through the drop. So let's take a look here. Now the first thing you notice is $290 a share. That's pretty pricey to pay for a little protection. So what we want to do is we want to try to eliminate the cost, but we don't want to pay too much for it. So if we go look at the options here, we'll just drop down this little chain here. I'm looking in November, the monthly November monthly options. Now, what we noticed, just kind of like first glance here, you've got 290, right around 290.50. Right here is the current price of the closing price of the S&P. Now, if you were to simply buy a put at 290, well, that would cost you, let's call it $3.80. So what that would do is it would essentially have control over about 50 shares. Now, why do we say 50 shares? Because whenever you buy an at-the-money put, which this is close enough, it's not perfect. When you buy an at-the-money put, it is equivalent to about half of the amount of shares of stock. So in this case, it kind of shows it here, about 45 shares out of 100. So you'll have protection a little bit to the downside, but not one for one. And so you can take a look and say, well, 380 is too expensive. And the further you go away from the price of the current price of the stock, the less protection you're technically buying. You could see if you went to 286, you would only spend $2.75 to buy a put. Maybe that's what it would cost. Now, that would only be the equivalent to having about 33 shares of the SPY. So it gives you an idea of sort of what to expect profit-wise out of that. Should this move $1, you would make about $33, right? That's about all it would be. 33 cents, but essentially $33. So it gives you a feel for protection. So while the trade of the week is not necessarily which one to choose, you want to start here at this 290 and go, okay, for the most protection, given the amount that I'm going to pay, really about 290, maybe 291 is the best I'm going to go. You're not going to pay more. Most people don't ever pay more. It doesn't make much sense. You're just paying extra money for something that already has a value that you could get down here for less money, is probably an easy way to say it. But if you were to buy this for 380, of course, you'd have a little protection on the downside, and then that would help offset some of the declines in any long positions you have. So the moral of the story is look in the November expiration for the SPY or equivalent ETF. If you like the other ones, that's fine too. And we're looking to buy puts for simple protection. Now, we can start at the money. I would suggest you start there. But if you want less and less protection, then go lower and lower as far as the price goes, and you'll actually save a little bit of money for less protection. So that's it. That's our trade of the week, buying protective puts on the SPY relative to how much risk you're trying to offset. I hope that helps. I hope it makes you a profit and it protects you from some of any declines should the stock market get a little top heavy here. And we'll talk to you soon.